Harsha, so good having you. Thanks so much for joining in. Um, what's the stance been at your end at Kotak AMC currently? Because we've seen the broad numbers coming out from the DIs at the end of every single day starting to look a bit iffy. Is it largely because of some redemption pressures, which I doubt very much, or is it that the inflows have slowed down, or is it that DIs are just booking a bit of profits after the run of money that they've deployed for the course of the first 9 months?
Well, in terms of inflows, the strength still continues quite okay. We have not seen any let up in terms of inflows into our funds at least. If at all there is some amount of less activity, that could also be because of the sharp run up that we have seen over the last few weeks in terms of markets. Maybe some of the market participants are just waiting for their prices to get reflected on the market, and maybe they will be buying at lower levels. But in terms of investor interest, I think the interest continues to be still very strong.
Has been the flow patterns in the month of October, because August and September were great months, even though global markets were volatile. Indian investors, they kept their faith.
Yeah, until now we haven't seen any change in that trend. More or less it's continuing in the same rate. So I would say that from domestic investor perspective, there has not been much change, but the change that we have seen is clearly from the FII perspective. In the month of August, FII sold about $2.5 billion worth of equity. September it abated to a level of about 750 million or so, and this month clearly they have been on the buy side. So this is the first month after a gap where we have seen both domestic institutional investors as well as foreign institutional investors being on the buy side. I think that's what is holding up the markets now.
Are you convinced that the worst of the price print for this calendar year and this financial year is behind us? Same time a month ago we were discussing global problems. Every conversation was centered around China and the impact of China on other emerging markets. But October has turned out to be a great month so far, not only for emerging markets but also for FI flows.
Clearly, we do not think that the markets are going to run up from here on. Clearly, this quarter results are unlikely to be very exciting from a market perspective. We will see a patchy set of numbers across most of the sectors. So to that extent, we really don't see any upside triggers which can take the market sharply from here on. Our view has been markets would consolidate around these levels for quite some time. Maybe for next couple of months it will consolidate around current levels, and then probably because of the earnings momentum that will gather sometime in the second half, we will start seeing some pickup in stock market performance. That's what has been our view, and we are sticking to that.
Where's the bias right now, Harsha? I mean, we've started off the earnings season. What do you expect from this lot of earnings? Where do you see your bias building?
I think clearly urban consumption has held up quite okay, and that is where you will see much of volume growth coming in. And if the companies have managed their businesses well, I think that's where you will see a good amount of profitability as well. So we are focusing on that entire basket of urban consumption. Not that we are going to be buying at all levels, but clearly this is a space to look at, and if there is, in a volatile market, if there is an opportunity to increase our position at lower levels, then definitely we would look at those options.
The other bit is breaking it down. I heard your comment in the morning, or rather the start of the interview, that you mentioned that earnings are not likely to, raise any eyebrows this quarter, at least on the upside. What about the scare on the downside? What could disappoint? Because the jury is split on IT and how it has started off. Few people believe they haven't been the best numbers. A couple of people believe that maybe IT numbers are pretty much in line. So the jury is split there, but the kick-starting of the earnings season hasn't been the most robust this time around. Is there a scare on the downside for any of the sectors based on your analysis that you guys have at Kotak AMC?
I agree. I mean, clearly this has not been one of the great earnings season. I think on the downside, the metal sector and the commodities, commodity plays can disappoint. But maybe to an extent it's already there in the price, but Other than that, most of the results will not be same across the sector. They could be quite divergent in terms of numbers within the sector itself. So to that extent, you may have to look at some of the stock specific opportunities that may be there in other sectors. By and large, we believe that auto, cement, pharma should be okay in terms of earnings numbers. IT has been kind of iffy. Some companies have been in line with consensus or better than consensus, but mostly it's been below consensus kind of a earnings season for IT. Private bank should be okay. Public sector banks will continue to have issues, is what we believe.
Do you still believe in IT, given the initial earnings that we've seen so far, from a value return perspective?
No, we were running underweight position in most of our schemes even before the earnings season started. Clearly our view was, while there has been some volatility in the market, and IT being a defensive sector will give a relative outperformance in the very short term, and also rupee depreciated at that point of time. But these were all short term factors, and from a longer term or a medium term perspective, clearly we felt that given the fact that global growth is so sluggish and there is pricing pressure, IT companies are unlikely to really give better than market kind of earnings growth over the next 1-2 years. We stick to that view because the first quarter results, at least the ones which have come out, mostly have been proving that stance, and we continue to remain underweight on the sector.
Are you not impressed with the kind of management commentary we've got from TCS or Infosys? Everybody is acknowledging the fact that digital kickers have kicked in. TCS has gone on record and they've said that, look, our order book for Q2 has touched a record level, and Q2 has been an exceptionally strong quarter for fresh order intake. So if the management commentary is indicating towards a better environment, do you think markets are somewhere mispricing or miscalculating the way forward?
No, I do not think so. While digital has been contributing to higher growth, there are also other verticals where there is still issue in terms of growth momentum. And at the end of the day, I think pricing pressure, which many companies have not acknowledged, is also existing. So overall, from a growth as well as valuation perspective, there is nothing that really makes the IT stocks at current levels very attractive. We continue to believe that there will be market performers, and that's where we think there are other sectors which can possibly give better returns from a 1-2 year perspective, and we will look for opportunities in those sectors where we believe growth is going to be higher than the market rather than in line with the market.
We were just discussing right now, a little while back, Harsha, about how, Rio Tinto has put out their forecast for the year. They've held out production targets for this year. They've also said that their shipments, iron ore shipments, have actually jumped up 17%. We've seen in the past some brokerages like Morgan Stanley, given the kind of extended selling that commodities have seen at the start of the year till now, reverse their course and say, it's a time to upgrade some of these names, especially Rio Tinto and BHP Billiton. Which side of the story are you on, and how are you seeing, the case of perhaps commodities turning around from here? Not immediately, but at least the bottom being in place.
Well, we all know where the global growth is going. I mean, there is no excitement at all. Global growth has been very sluggish. Chinese growth has been slowing down quite considerably, which happens to be one of the biggest users of iron ore. So it's very difficult to believe that the growth numbers that you mentioned is going to sustain going forward, given where the global growth is. And I have not really looked at the numbers closely, but it could also be because of inventory destocking, restocking that could have happened in the same period last year or this year. So I do not think that given the sluggish global growth, this kind of production growth or volume growth can sustain going forward. At least we are not in the camp that believes that there is going to be overnight V-shaped recovery in commodities markets or commodity stocks. We continue to believe that this phase is going to linger on for quite some time, and hence we maintain our underweight stance on the sector in terms of Indian metal stocks.
Right, Harsha, really appreciate your time. Glad you could join us.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.